John A. Allison, The Financial Crisis and the Free Market Cure, Why Pure Capitalism is the World Economy's Only Hope. Delve into the thought-provoking book, The Financial Crisis and the Free Market Cure, Why Pure Capitalism is the World Economy's Only Hope, by John A. Allison, as he debunks conventional narratives on the causes of the Great Recession. Instead of blaming Wall Street greed and deregulation, Allison sheds light on the role of irrational government policies in exacerbating the crisis. Throughout this summary, unearth the 6 key causes, consequences, and cures related to capitalism: the Federal Reserve's involvement, extensive banking regulations, housing policies, subprime mortgages, and government bailouts. Absorb precious insights on the importance of returning to free market capitalism and effective policy reforms for a sustainable banking sector and a robust economy.
The real culprits of the Great Recession. The Great Recession is widely believed to have resulted from Wall Street greed, complex financial instruments, and capitalism. However, this book argues that irrational government policies played a significant role in the crisis. The author identifies 6 crucial factors responsible for the recession and suggests possible remedies. This thought-provoking read challenges traditional assumptions about the root causes of the financial crisis and broadens readers' perspectives on the subject. Banking regulations in a nutshell. The book challenges the popular belief that the 2008 financial crisis was caused by banking deregulation and greed on Wall Street. The author argues that in reality, 3 laws implemented during the George W. Bush administration created regulatory burdens that increased costs for the financial industry. The Sarbanes-Oxley Act, which addressed accounting fraud, resulted in high audit costs. The Patriot Act required financial security measures to identify terrorism money, costing banks $5 billion in expenses. The Privacy Act mandate required disclosure notices sent to customers, costing hundreds of millions of dollars annually. The combination of these legislations imposed regulatory burdens on the banking sector, leading to an increase in costs and risk, culminating in the financial crisis. The book emphasizes that government interventions may not always provide a solution to market imperfections and that excessive regulation could have unintended consequences. The housing bubble collapse. The American dream of owning a house was supported by the government's incentives to expand home ownership rates since the 1930s. Various programs provided financial enticements to individuals and lenders, leading to an overallocation of capital and a bubble in residential housing. The government-sponsored enterprises like Fannie Mae and Freddie Mac played a significant role in this too. In 1999, the Clinton administration mandated that 50% or more of all loans held in the GSEs should qualify as subprime, followed by a surge in mortgage financing that seemed like a no-lose scenario for lenders and homeowners. However, the bubble in residential housing soon collapsed due to an increase in the Fed funds rate by 425% in 2006 and 2007 by the new Fed chairman, Ben Bernanke. The GSEs had amassed a risky $5.5 trillion portfolio, with $2 trillion in subprime mortgages and with leverage of 1,000 to 1, which ultimately resulted in the housing bubble collapse. The banking sector and the 2008 financial crisis. The banking sector is essential to commerce and drives the economy by providing capital and liquidity. Financial firms take in funds from depositors and deploy those dollars into loans, participations, and investments. However, too many Wall Street institutions piled enormous debt and risks onto their balance sheets, with pre-crisis leverage ratios standing at approximately 30 to 1. The Federal Deposit Insurance Corporation, FDIC, protects depositors' funds held in banking institutions but exercises shoddy governance of the financial industry and rewards risky behavior, cementing a belief that government will rescue banks deemed too big to fail. The subprime meltdown was central to the 2008 crisis, but its cause was heavy capital misallocation into residential housing in the prior years. This misallocation led to the national housing prices being 30% higher than people could handle, leading to a complete washout of capital that triggered a liquidity crisis. Institutional investors owned many toxic residential mortgage-backed securities, RMBS, certified by rating agencies that failed due to a poor understanding of subprime loan loss metrics. Financial firms outside the traditional deposit-based monetary system are labeled as shadow banking entities and dealt in innovative derivatives and myriad other instruments. Regulators' policies encourage almost all the financial institutions in the market to make the same mistakes, leading to the 2008 financial crisis. The paradox of government intervention in the financial crisis. Politicians' and bureaucrats' attempts to prevent a financial crisis resulted in rules and regulations that may cause the next one. The Troubled Asset Relief Program, TARP, bailout made taxpayers responsible for keeping banks that should have failed afloat at arbitrarily high prices. Even non-banks such as General Electric and General Motors received capital injections. Community banks that should have closed remained open, damaging the profitability of strong ones. The FDIC insurance changes incentivized bankers to take more risks than they should, leading to the crisis. Dodd-Frank reform imposed extensive regulations but did nothing to reduce FDIC insurance levels or limit government intervention in too-big-to-fail institutions. Subsidies to poorly run firms undermine prudent risk-taking incentives and hinder viable institutions' development. The need for a return to free market capitalism. The Great Recession and economic concerns have sparked a debate on the role of government in promoting economic growth. While altruistic leaders support government's role in guaranteeing goods and services to citizens, this diverts capital from investments that grow the economy. The philosophy of individual rights emphasizing personal responsibility in limited government must guide policies for a mutually beneficial relationship of individuals with others. Free market capitalism rewards those who create the most productive ideas, products, or services, as determined by other productive people in purchasing these. The government's interventions in the financial system during the crisis created more interventions, which deepened and prolonged the recession. The leaders could have better served the economy by letting prices reach equilibrium and allowing weak firms to fail. Therefore, public officials in corporate America must promote a return to free market capitalism to enable individuals to think freely and enjoy well-being. A call for limited government and free market capitalism. The United States is on the brink of a looming disaster, and the only way to avoid it is by returning to limited government and free market capitalism. The government's reliance on itself crushes the opportunity for individuals to pursue their potential by taking control of their own destinies with a dedication to excellence. A sustainable banking sector should consider abolishing the Fed and reintroducing the gold standard to discipline financial markets. Moreover, policy officials can introduce crucial reforms such as reducing or eliminating the FDIC safety net, privatizing Fannie Mae and Freddie Mac, and diminishing political subsidies for social programs to promote investment over consumption. To improve living standards, productivity should be the focus of leaders by enacting low marginal tax rates, cutting government spending, reining in unfunded liabilities of Social Security, Medicare, and Medicaid, promoting global free trade, expanding legal immigration of productive foreigners, and promoting savings and investment.
In conclusion, John A. Allison's book, The Financial Crisis and the Free Market Cure, convincingly argues against the standard narrative surrounding the Great Recession. It is not capitalism or Wall Street greed that led to the financial crisis, but rather a myriad of ill-advised government policies concerning capitalism, the Federal Reserve, banking regulations, and housing policies. Allison emphasizes the need to return to free market capitalism with limited government intervention, and proposes far-reaching policy reforms to restore economic stability and growth. Embrace the principles of low taxation, reduced government spending, cutting regulatory costs, and disciplined political process that supports savings, investments, and individual rights to ultimately pave the way for a robust and resilient economy.